Hi, thanks for all the responses to the last video on the home capital group, the whole subprime or the housing market type thing. It was great to hear from everybody. I want to talk about discounted debt in the form of bonds and debentures. I follow two fund managers who have used this in the past. Prem Watsa, who runs Fairfax Financial in Canada, and he bought debt on Nortel when Nortel was going out of business. When companies go out of business, the first people who get paid are the debt holders, not the shareholders. So he saw there was enough cash on their balance sheet, and he was able to buy the debt at, like, I don't know, I think he said 20 cents on the dollar. Similar thing with David Tepper down in the United States. He did the same thing for, I think, MCI WorldCom and Enron. I'm having troubles finding these kind of opportunities in Canada, or at least through my online brokerage. The only place I've found it is in convertible debentures. And so I wanted to share my experiences with convertible debentures and also ask some questions of people out there as to other ways to find these opportunities.
So let's look how I'm exploring making money with discounted debt. But before we start, as usual, I'm a do-it-yourself investor, self-taught. I'm not a financial professional, so I'm not giving advice. However, this is for education, entertainment, to open ideas up to people who haven't heard them before, and also to get ideas from people who are out there. I'd like to thank everybody who has sent stuff from the last video, but please always do your own due diligence and make your own decisions when investing, and seek a professional advice if you need it. Okay? So discounted debt is something that I've always sort of been aware of, in the sense that I study some of the hedge fund managers that I found that have been very successful. Two of them, the one in the picture right now is Prem Watsa, who runs Fairfax Financial, and they're sort of like Berkshire Hathaway in the States. He's sometimes called the Warren Buffett of Canada. Anyways, I did watch one of his presentations on YouTube, and he mentioned how when Nortel Networks was actually going out of business, at Fairfax Financial, they purchased debt. And the reason they purchased debt is because even if the company does go out of business, the first people that they're responsible to pay out is the debt holders rather than the shareholders. So sometimes holding debt is a little safer in a bankruptcy case. In this case, because the stock was going down and the company was going down, for a dollar's worth of debt, he was only having to give up 40 cents. As a result, the interest that they pay on it would be at a premium, and so would the payback of the par value on maturity. Basically, he was getting 40 cents on the dollar, so he was getting like 2.5 times gain as long as they could pay back. And whatever the interest rate was at the time, it would have been a premium, because the amount that they pay out would have been on $40 instead of $100. So it's a pretty good situation, and because the first one's being paid out, even in the event of a bankruptcy. In this case, he said there was $4 million in cash and $4 million in bonds. As a result, he felt fairly confident that they could pay back the debt regardless of whether or not they actually went out of business. Another hedge fund manager I watch, and who's a very good hedge fund manager, over the last 15 years, he's averaged 25% a year, is David Tepper, who runs Appaloosa Management. He does a number of different ways of investing, but distressed debt is one of the things that he does. And he made 148% for his Appaloosa Management back around the time of right after the dot-com bubble, and he did it by buying distressed debt from Enron, MCI WorldCom, and Conseco. Once again, these are companies that their stock prices were crashing, but I guess he could see stuff on the balance sheet that made it worthwhile doing. And so this is what sort of I'm looking at doing. Obviously not to the same level as these guys, because these guys actually get involved with the company, but I do see opportunities at times where debt is sold at a discount And if I look on the balance sheet and I see that there's enough cash and short-term receivables to cover off all the liabilities of the company, I feel pretty good about it. And even if it's close there and they have a positive cash flow, that's a good thing too. So I balance the two. If the cash flow, if it's draining cash, then they better have a really healthy balance sheet. And if the ideal situation is where they're not draining a lot of cash and the balance sheet is solid enough to pay the debt. So I had my own opportunity to do something similar to this, and that was with TransGlobe Energy. It was a company that I actually held the stock on. It was an oil and gas exploration company that operates out of Egypt. They had really good fundamentals and they're paying a good dividend, but when oil commodity prices crashed, TransGlobe became a victim as well as everybody else. It took them a little while, but when they did, they started to show a net loss. Their net income, well, they didn't have a net income. They had a net loss on their income statements. So around this time, I also found out that they were issuing debentures. So I purchased some in March 2016. These debentures had been on $100 been. I ended up buying them at 90, but they were offered at 70. I don't know, $75, $78 to $80 at some point, which would be a significant discount to the actual $100 value you'd get paid back. As well, they paid a 6% dividend that would probably be up around 7.5% when you apply it to the actual price you were paying for the actual debenture. So as I say, I've got a few points here. So I purchased them in 2016. They had a positive net current asset value, which means that their cash and cash receivables, actually I put this in the next point, cash and cash equivalents were 122 million. Their total liabilities were 86 million. So they had a significant surplus over and above what they owed. And in 2014, they still had positive cash flow, even though they were showing a net loss. They did turn over to a negative cash flow in later in 2015, but the strong balance sheet in that, it was very comfortable because there was probably a little over a year left that they were going to have no problem paying this debt. And they did pay it out, and they paid me all the interest. The coupon rate or the interest rate was 6%, but it was like 7.5% based on what I paid for it, or 7. It was higher anyways. I sometimes get mixed up. I really wanted to get in at 80, and just a little confusion with my online brokerage caused me a bit of a problem. So when you take a look at it, and I got the cursor here, so I bought in around here. There was opportunities down here, and I know because I've been following the company, it was around between $80 and $82, and all those things, the positive net current asset value, as well as positive cash flows were happening at that time, or in around that time. So this is a pretty strong opportunity to buy $100 for $80 and get a 6% dividend that would have been pushed up to like 7.5% dividend over the next year. So potentially there was the potential of a 25% return on the actual bond being paid off, and then on top of it another 7.5%. So like 32.5% locked in for just a little over a year. To me, that seems like a really cool thing to do. So anyways, I'm trying to find similar type things. It's hard to find them discounted. And I also don't have, I seem to only have one list, and that's off the Toronto Stock Exchange. So I'm hoping people out there in the community can help me with some of this stuff. I have a couple of questions at the end I'm hoping that some people can help with. Anyways, so I have recently purchased a debenture for Boyan Construction Group, and this is just a screenshot from Guru Focus. And if you take a look at this, oops, I just went backwards. Let's go this way again. Okay, sorry about that. So if you look at the blue bar to the right and the green bar to the right, the blue bar effectively is cash flow. and the green bar to the right is the net current asset value. So the net current asset value means that they're right here. They have in their net current assets, they have significantly more than they have liabilities. On the earnings side of thing, their earnings power, their cash flow is also positive. So this looks like, to me, once again, another positive situation. I got in at, I think it was $97 for a par value of 100, which isn't a huge discount, but considering they have a coupon rate of 11.5%, which is closer to 12% when I buy at the discount, this is another one that I'm going to try. I've got two of them right now. As I get better at these and more confident in these, I will probably start putting more money in them but the key thing is reading the balance sheet. And if you know how to read the balance sheet and observe the cash flow statements, you can give yourself a fair amount of confidence as to whether or not they can pay back. And that's, I think, is the most critical thing. A lot of these are the debentures that I'm buying, they're convertible too. So you can get stock in exchange for them. So if you bought it at a discount, you can get the stock at a discount too. The only thing for me is right now I'm mainly focusing on making sure that they can pay back the debt less than, if there was a great opportunity where the stock was like, it was a company I really wanted to own and they were turning it around and that maybe I would take the stock option or the convertible portion of the debenture. But in most cases, I'm mainly focusing on them paying back, paying the interest rate and getting a premium because I bought at a discount. So this is Boyer Construction again, which I just showed you the sheet, and this is the chart. So actually, back in 2013, 2014, you're looking at $40 to $60 for the $100 debenture, which would have been a great discount. I didn't follow it at that time, so I can't say what the fundamentals were on the balance sheet, but balance sheets don't move really quickly, so I'm going to assume that they had a pretty solid balance sheet then too, and that would have been a great time to buy in, because then you'd potentially have, at $40, you'd have 150% appreciation when you got paid out for the par value of the bond, and then on top of it, your 11.5% would actually be the interest would actually be 28.75, so almost 29% annually. So you would be locking in some really great deals. I want to find a lot more of these, and I'd like to actually look at a list that's bigger than the one that I've got. But this is an interesting way, and if you've watched my video on how I manage market risk, I like to go to fixed income and cash a bit when I think the markets are overvalued, or have a bigger portion of my portfolio in those things. But nowadays, a lot of bonds and GICs, the interest rates are so low, but when you pick up these convertible debentures and bonds that are selling at a discount, you do get nice returns on them, as long as, once again, it all comes down to whether they can pay the debt at the end, and that's the critical analysis here. So this is a list that I get off the Financial Post, and it's basically convertible debentures for the Toronto Stock Exchange. This is the whole list that I have to deal with. I know there's others out there. I even know the the Venture Exchange for the Toronto Stock Exchange, which is out of Vancouver, has debentures, but I don't know where to find them. This is the only real list that I've got. I also know that there's debentures stateside, and I don't know where or what market you can buy them in and that sort of thing. So one of the things I'm hoping from the community is if you're investing in discounted debt, where do you find it and where can it be bought? Particular stuff in the States or Vancouver Stock Exchange. I haven't found as convenient of a list as I have for the Toronto Stock Exchange, and would like to find it so that I can research more discounted debt to find these situations where the cash is there on the balance sheet and the operation is not bleeding cash, so it looks like paying the debt's pretty much a certainty. The other thing I'd like to hear from people is and you can leave comments down below or put links in, is when you analyze these kind of situations, I'm looking at, the net current asset value, and I'm looking at cash flows. Are there any other particular things that you look for that make you feel comfortable that the debt can be paid? Anyways, that's it. I will have links to the different graphs that I have, as well as a link to Stock Story, information about myself for those of you who don't really know much about me. And I look forward to sending out the next video, and I hope you're all doing well. And we'll talk to you later.